So it's the 10th of April, and I'm going to do the monthly watch list review where I review stocks on our UIP watch list. So these are stocks that are not in my portfolio, but they are in my watch list. Some of them I would add them to my portfolio at the right price. Some of them I won't, simply because I have got too many of similar kind of stocks. So let's look at the list right now. Before that, let me do a quick update on to the overall markets. So let's begin with the S&P 500. And like we expected, after a strong wave up, we will have a pullback, right? We can't go up in a straight line. We need to have a wave down, wave up, wave down, wave up, wave down, right? So I said expect a retracement, and we have had a retracement, as you can see, over the last couple of days. So after this wave up, we got this retracement, and we are currently right at that 200 moving average. So the good news is the 200 is still sloping up, so that means the overall long-term trend is still up for the S&P, and we're kind of like consolidating at the 200 moving average. We are also still above the 50 moving average, which is sloping up as well, and the 20 is still above the 40 moving average. So I would say for the S&P on the daily candles, it is still on an uptrend. It is still a retracement on that uptrend. Now, again, could we break below that 200 moving average? Could we break below that 50 moving average and this reverses back into a downtrend again? Everything is possible. We can't predict exactly what's going to happen. It depends on how events unfold. But for now, looking at the charts, it still is on this uptrend pattern until the thesis is invalidated by the price breaking back below the 50 moving average. Things start sloping down, and then we say, okay, that uptrend has been broken. But for now, not just yet. If we look at the weekly candles on the S&P, the weekly candles still look pretty bullish, right? So you can see on the weekly we had that downtrend, and we broke above that downtrend resistance. And right now, we are still above the 50 moving average on weekly candles. So that still looks pretty bullish as well. Now, the only thing that looks more bearish, is of course the NASDAQ. The NASDAQ has been more bearish, right? In fact, the last trading session, you saw the Dow Jones actually went up. The S&P was flat. NASDAQ went down. So it's part of this rotation that as the market expects higher interest rates, what happens? You find there's a rotation of money into more cyclical companies, into companies that have consistent profits, and away from the high-tech companies that tend to be more loss-making. So for those of us who are holding tech companies like Amazon and Microsoft and Google and Facebook, no worries, because these companies, yes, they are tech companies, but they are making money. They are printing free cash flow. They've got conservative debt. No worries. It's people who are holding those speculative tech companies that don't make much money. They are the ones that should be shitting their pants. Okay, so not much worries for us, even with this volatility. Now, looking at the NASDAQ, people are freaking out because it couldn't break above the 200 moving average, right? It hit the 200-day, it came down, went up again, hit the 200-day, came down again. So can't seem to break that 200 moving average. And on the NASDAQ, you can see it is still above the 50 moving average. That's a saving grace. But again, could it break below that 50 moving average? It could, right? And we could see a retest of those previous lows on the NASDAQ, right? And of course, the worry is that if that happens, could it drag the overall S&P down into a bear market this year? Now, I still believe that even if we retrace lower and we see a lot more volatility in the next couple of months, I really do not see a bear market. All right, I really do not see a recession. Why? Based on looking at a lot of the fundamental metrics, right? I just don't see that happening unless something exogenous happens that no one predicts, right? But based on current historical metrics, I don't see that happening. Okay, like I mentioned before, the inversion of the yield curve means nothing right now because the 10-year yield is still rising, which means people are still selling long-term bonds, which means people are still bullish on the long-term growth of the economy. That's number one. Number two, the yield curve inversion has re-inverted back into a normal yield curve. So that's not something to be concerned about. What people are concerned about, and that's what caused the second dip in the NASDAQ, is the Fed. A few days ago, they said, you know what, inflation is worse than we thought. We're going to have to raise interest rates more than expected. That instead of a 25 basis points increase, which means a 0.25% increase, they are looking at a 50 basis points increase, which means increasing interest rates by 0.5% in each of the Fed meetings. So they could be bringing the short-term interest rate up to 3% or 3.5% this year, which is a lot more than expected. Now, people are freaking out because, again, they say, oh my God, higher interest rates, would that cause a recession? I don't see that happening. Now, again, remember that, let me just show you this chart right here. Okay, you can see that on average, whenever the Fed increases interest rates, normally it's telling you that, hey, the economy is almost at full recovery, right? At full recovery. And that people say is the end of the economic cycle. But not just yet. I would say that we are probably at the end of the mid-cycle of the economy and not really at the end of the cycle, right? If you take a look at this historical table, you can see that historically, from the time the Fed increases interest rates, the date of the first rate hike over here, back in 1958, 1963, 71, 75, 1980, 83, 94, 2004, 2015, right? From the date of them raising interest rates to the peak of the market, which is these dates over here, you can see between those two events, the number of years can be 3 years, 2 years, 1.7, 5.4, so on and so forth. So if you take an average, that's about 3.4 years. And a median is 3.3 years. So what that means is that on average, after the Fed increases interest rates, bull markets continue to run for about 3 to 4 years more before peaking and going into a bear market. And between these two events, the S&P can still gain quite a bit of ground, right? In fact, on average 67%, median 49%. Now, at the same time, if you look at the jobs numbers, the jobs numbers are still very, very strong. The job market is still very, very strong. So, a recession only happens when wages fall. When unemployment goes up. That's not happening, right? In fact, unemployment is still dropping. It's not going up. And wages are rising. So that's why I don't see any possibility of recession right now. Now, of course, the other fear is that, hey, could super high inflation cause the crash? Possible, right? So inflation looks like it's going up, getting higher and higher. Now, remember that inflation is caused by two things. It's caused by excess demand and not enough supply, okay? So the Fed wants to increase interest rates to reduce the demand for goods and services. Now, here's the thing. I believe that if you look at what's happening now, because of very high inflation, people are already cutting back on their spending. And if you read the numbers, you can see that sales are beginning to weaken a bit because of that, right? So in other words, before the Fed actually increases interest rates in the next few meetings, this could already start coming down naturally because people cut back on their spending. At the same time, the mortgage rate in the US, the 10-year mortgage rate has gone above 5%, if I'm not wrong, all right? So that is already causing people to reduce their demand for housing, right? So that should also cause house prices to start to moderate. So that would naturally cause demand to drop, okay? Now, at the same time as the borders open up, right, and if the war in Ukraine can, slowly become sorted out, that would ease the supply constraints and supply should increase, and that should bring inflation down in the next couple of quarters. So what I'm saying is this, that although the Fed is saying, hey, we have to raise rates aggressively to tame inflation, even before they need to do it at the second, third, or fourth meeting, inflation may already come down because of the natural drop in demand from high prices and the natural improvement in the supply chain. So we'll see how that goes for that, right? So like I said, that's my thesis. I could be right or wrong, I don't know. But again, remember that as investors, it really doesn't matter whether we go into recession this year or 3 years from now, whether we go into a bear market now or next year. It really doesn't matter. Why? Because our job is not to predict the short-term direction of the market. Okay? Our job is to just ensure that we hold a portfolio of diversified great companies that would keep growing over the years. Sure, they may go up and down in the short term, but they'll always grow over the years. And to ensure that we are diversified, having enough defensive companies, enough growth companies, so that we have got good gains with minimal volatility. Okay, so after my long-winded review on the markets, let's take a look at the watch list.